Good evening and welcome to the FITT Show. I'm Bobby Kinzer.
And I'm Thomas Doty.
And we are the FITT Show. Financial information for today and tomorrow. How are you doing today, Thomas Doty?
Doing great, back in Jersey with the grandkids and happy to be alive.
Well, that's a good thing, man. That's a real good thing. Had a great show last week talking about the different kinds of new scams, especially the stealing your deed, theft of your deed. That got a lot of responses from people. But this week we're going to be talking about CDs versus bonds, and this is going to be pretty interesting because a lot of times people don't go into the real, what we say, safer type of investments, which we call CDs and bonds. But there is a difference, and they do have a place for your portfolio. But before we get into that, I just want to remind you all that please click on the like button. That always helps us get more traction. And though we loving your chin, but there we go. And click on the heart button. And please put comments into the box because that helps us get even more traction. And we look forward to getting your comments. You know, if you have opinion on what we're talking about, or if you have a statement that you'd like to share with us, or if you have another topic, or you have a question you'd like to ask us, we look forward to answering that particular type of question. Now, I know people were probably wondering, what does that Bob have on SFEPD? That's the Society for Financial Education and Professional Development. I consult with them, and today I just was over at the Alexandria Detention Center in Alexandria, Virginia, because I taught a 6-series financial education class within the prison. And they gave awards and certificates to the guys because they were so thankful for being able to learn. Because normally they're getting conflict resolution, anger management, re-entry type programs. And they were happy to learn about finances, which I thought was so great and so engaging, and I had such a captive audience. But Dope, I had to get that in. So
that's cruel, Bob.
So let's get into our top of the show topic, which would be the stock market. Now I know though you gotta have some good news finally once for us with the stock market. What you got?
Can't worry about day to day and week to week. And you know, we always talk about investing for the long haul, man. That's what you got to think. There's been downs. And if you look at the week, it doesn't look like it had a lot of activity. The Dow's down about 400 points. A lot of that was today, but you had a couple big days and a couple bad days. NASDAQ's up a bit, about 1%. And then you look at the stocks I follow, Microsoft's up a little, Tesla's up a little, Apple's up a little, and Pfizer's down $1. But NVIDIA, they announced earnings after close last night, and they're up like 39 points. But they had taken a step back last week, and so they're still a little short of the all-time high, which is around 481. But it's still going like gangbusters, and all on the strength of AI. But everybody's a little worried. Today, the market took a pretty big hit, and everybody's a little worried about what Powell is going to say tomorrow. You know, we give his Fed update, and everybody's a little more hawkish and a little more nervous about interest rates continuing to go up. And just got to hang there with this until the markets get some steadiness to it. Because right now it's up one day, down the next. So just got to hang in.
Well, that's going to be the interesting thing of our show today, though, talking about the movement of interest rates up and down, how they affect CDs and how they affect bonds. We know how it affects the stock market, but it's going to be an interesting conversation to talk about those things. I was reading, they were talking about, though, I just want to say this, I always talk about, you know, the economic indicators like the GDP, the gross domestic product, you know, how we doing goods and services. we are growing faster, our economy, than China. First time in a long time. And that may not be major news to people, but that is major because China, they were just putting out stuff. And China's now down below the rate that we're going at. And I think we probably at somewhere at 3 or 4 or more. And China's below that. So despite what people are talking about, the American economy, and we always talk about this, people who have money seem to be doing better than people who don't have money because you say the economy's doing good, but yet there are a lot of people out there that don't feel that because, the prices that are out there these days. But no, the market, America is really making some moves, especially in the job market, because the job market, unemployment rate is down and the job rate is up. So I just want to share that information with everybody. So it's not all gloom and doom, but just keep an eye on those indicators. Let's talk a little bit about the cryptocurrency market. This is interesting. The first time that the total market cap for cryptocurrency has been flat at $1 trillion. Bitcoin actually been going down. It went down another $689 per Bitcoin to $26,094. That's down about 3%. And then all other cryptocurrencies, just nothing really has been going major with them. Dogecoin, it went down to 10, but it moved back up to number 9. And CBNU is still hanging in there, moved up from, several spots that was lower weeks ago. So the cryptocurrency market has sort of been, just kind of just steady, just staying there in a place. And we really don't know what drives that. They mostly says usually was the customer sentiment, but just keep an eye and like we always say, hold on for the long play. So let's get into our subject for today, which is CDs versus bonds.
And trying to decide between investing in a CD or a bond, because both offer you a secure way to earn a return. Returns are going to be modest, if you compare it to stocks or some other investments that are out there. But these CDs and bonds offer investment safety and steady returns. You're assessing your risk, your return, and how long you plan on having the CD or bond is going to help you determine which one's right for you. You got to weigh those differences and see which one's a fit. And for folks who are conservative, this is usually a big part of their portfolio. And so, like for me, my portfolio might be 30% conservative things like bonds and CDs. But for somebody like Bob, who's a little more risk averse, he might have 60% of his portfolio in CDs and bonds. And that's okay because you have to do what you're comfortable with. And so depending on where you are in the investment spectrum, you may put more in CDs or bonds, depending on, what your own risk tolerance is and where you are in your particular situation. But you have to realize that the returns on those CDs and bonds is overall, over the long haul, going to be less than it has been in the stock market.
Yeah, I mean that's just how it is. Because last year, though, the Federal Reserve reacted to the surge in inflation with aggressive rate hikes, and stocks got hammered. The Fed had continued raising rates, driving up the yields across the Treasury curve. And while plenty of attention had been paid to recession warnings sent by inverted yield, the inverted yield is normally when interest rates were going down. That means bond prices was going up, but when interest rates were going down, bond prices started going down. It would create an inverted yield. But now, the 3-month yield is now for Treasury bills are close to 5.5. It's made cash like holding competitive with the stock market. And this is the first time in 22 years that cash, which is low risk investments, like we're talking about money markets and CDs, the interest rates are going up. Now, this is a year-long, the juicy yields are over 5% offered by certificate of deposits. And money markets have attracted, which is another cash equivalent record inflows of $925 billion, though. And that is telling us the year-to-year total in August already has best the record, which was in 2020 of 917 billion. So a year when investors were obsessed with safety, all of which has changed the investment calculus for a generation of investors who have known nothing except ultra low interest rates. Now, after a generation of investors being told TINA, you know what TINA stands for?
No idea.
There is no alternative. They say, TINA, there is no alternative to the stock market with bonds offering next to nothing. Because bonds, a couple of years ago, were just the rates on bonds are just low. It didn't make any sense to be in them. Investors are facing now a generational change in investing dynamics, and they're feeling the effects of new investing paradigm shift. And whether you look to increase your savings yield or hedge against the stock market volatility, both bonds and CDs can be a valuable additions to a diversified portfolio, but each has its own advantages and disadvantages. Now, to decide which is right for you, you need to consider your income needs, investment time horizon, and your opinion about the future direction of interest rates. Now, to help you figure out the best option, we will just discuss or give an overview of when CDs may be better than bonds or vice versa.
Yeah, well, let's start real quick with a brief overview of what a CD is. And that's basically a type of savings account you open with a bank, credit union, and you can also buy CDs through your brokerage firm. They're insured by the FDIC up to $250,000 per account, which basically reduces your risk to zero. And one trick, if you have that much money and you do put your money into an account, FDIC, you don't want to put 250,000 in, because if you get interest, then that would take your balance over 250, and only 250 is insured. So just a little trick to remember, you don't want to put 250 in the account thinking that's insured, because that's all that's insured.
No, it's interesting. When I was working for the FDIC closing banks, when it was $100,000, many of people lost interest, but they thought they lost the whole $100,000. But it's the same thing, though. They didn't realize just get it at a low amount so they can protect that interest too. So good point.
Right. So if you got if you're thinking 250 and the interest is going to be 10,000, only put 240 into the account. But anyway, when you open a CD, you agree to leave the money in a deposit for a set amount of time, or you incur a penalty if you withdraw it earlier than that. In exchange, the bank pays you a fixed annual percentage yield, APY, making a CD basically as safe, it's as close to no risk as you can get. It's a way to grow your money. Terms can run anywhere from 3 months to 5 years. Depending on your particular situation, you got to decide which works best for you.
So that's just a brief understanding. We know some of y'all know what CDs are, but let's talk a little bit about when to choose a CD. Now, CDs can help you reliably save for the near future. Deciding how long to keep your money on deposit is crucial, because there are penalties for early withdrawal. Now, a 3 or 5 year CD can help you save for extended vacation or for a down payment on a home. CDs with shorter term can help you accumulate earnings to build an emergency fund or gain fiscal discipline by putting money temporarily out of reach. Now, the popular thing about CDs is when the interest rates are high. Now, a crucial difference between CDs and bonds lies in how they react to interest rates. And this is an important concept of understanding these two investment vehicles. When interest rates rise, the annual percentage yield usually increases. That means that the CD rates offered by banks go up when the interest rates climb. Now, the Fed rate increases have forced banks to hike interest rates offered on CDs. The 3-month, 6-month, and 1-year CDs offer the best rates anywhere from 4.5 to 5.5%. In the short term, bonds can compete with those bonds can't compete with those return rates. And just remember, 2 years ago, CDs were down to like about 3%, maybe two. But risk adverse. See, CDs might be better option for most risk adverse investors, meaning people who don't like to take risks. They're very conservative. But remember, the lower the risk, the lower the return. But they're ideal for reaching short-term savings goal because you can choose from a variety of term lengths. CDs are great if you have a savings goal because you can earn more interest than a typical savings account without locking money away for long or risk losing it. Now, terms vary from bank to bank, so make sure you compare interest rates, early withdrawal penalties, and amount of time you really lock your cash away before opening a CD. Understand the time frame and that you need the cash before locking it away, before opening a CD. Now, there are no penalty CDs out there too. They can be useful when there's a possibility you may need the principal back sooner than given a CD term. Now, compared to traditional savings account, CDs are not a great place to have your money stashed in an increasing interest rate environment. Reason why? The savings accounts can raise their interest rates at any time, while your CD rates won't change after account opening. But CDs are actually safer bet than bonds when interest rates are going up. Why? Because the yields for bonds trading on the secondary financial markets will decrease as interest rates rise. But since CDs aren't traded on the markets, their yields are diminished by rising rates. Very important distinguishing difference. Now, if you expected rates to rise, buying short-term CDs for the foreseeable future may be the way to go. In this way, you can lock your current yield while giving yourself a flexibility to open new and hopefully higher CDs each time the account reaches its maturity.
But in some cases, you don't want to risk losing any penalties. With a CD, it's highly unlikely that you will lose any of your initial investments. And even if you have to pay an early withdrawal penalty, that's typically calculated on what you would have earned, okay? So depending on how long you held the account, the forfeiture of interest may not cut into your principal at all. But if you sell a bond before the maturity date, it can be a little tricky. And so you got to be really careful if you're talking about putting money in someplace that you might need to take out. If the current interest rates being offered on bonds are higher than what yours pays, you'll need to sell yours at a discount. Because if let's say you have a bond that's paying 4%, but now interest rates are 5%, nobody's going to pay you full value for something that's only paying 4% when they can get 5% in the market. So you'll have to pay a discount if you want to sell yours. And that's why it's really important not to put money that you might need in a short period of time into bonds. So if you want complete protection from this kind of volatility, then opening a CD account may be a better option for you.
Now, you may be asking, why are we telling you this about CDs and bonds? Because we talk about the stock market a lot, and we do believe in order to generate wealth, that you definitely need to get in the stock market. We always said that. But this is another means to maximizing your cash, maximizing your money. And these are just a little bit more safer, give safer returns. Now, you have a short-term investment horizon. With CDs, it's true that there are some short-term bonds that come with durations of 1 to 4 years. But if you expect to withdraw your money that quickly, a CD may be the simpler investment vehicle. Plus, with a CD, you won't have to worry about incurring any trade transaction costs.
Okay, now a quick overview about bonds. Bonds are basically debt obligations, issued by government agencies, and corporations to raise capital or to pay operating expenses. When you buy a bond, you're making a loan to that issuer, and the issuer promises to pay you periodic interest payments. and to repay the face value upon the bond's maturity.
So, with that, what do you get when you buy a bond? When you buy a bond, you receive a periodic interest payments known as coupons. The coupon payments, which may be made quarterly, twice yearly, or annually, are expected to provide regular, predictable income to you. Longer maturity terms make bonds a lower maintenance investment because you can lock in a stream of income for up to 30 years and avoid having to seek reinvestment at a potentially lower rate. That is such a good option with bonds. Now, bonds are not insured by the FDIC and they come with some risks. When buying corporate bonds, you can manage the risk by buying investment grade bonds, meaning AAA, AA, A, triple B, that have earned a higher rating from a credit rating agency. The least risky are Treasury bonds and U.S. savings bonds because they're backed by the full faith and credit of the United States government. Now, government bonds can be purchased directly at treasurydirect.gov. Now, you can buy Treasury bonds and savings bonds directly from the federal government without any fees, and they can also be purchased through a brokerage.
And if you want to think about when to choose bonds, they're definitely more popular when interest rates are low. Crucial difference between CDs and bonds lie in how they react to increased interest rates. We've touched on this before. When interest rates rise, bonds prices decrease. That means the bonds will lose market value if interest rates rise. If you sold a bond on the secondary market, you have to do it at a discount. So you don't want to get into bonds in periods of raising interest rates just because of the volatility. And we've talked about the Fed has increased 11 times since March 22. These rate increases have made bonds less appealing than CDs because CD rates are going up and they're up around 5%. And it's really hard to turn your back on a 5% almost guaranteed return. That's practically no risk. And I think most people would accept that rate of return with zero risk. Most people would. Now, if you've got a higher risk tolerance, if you're more risk tolerant, like myself, and looking for a greater return, you might prefer to have some money in bonds because, again, you have a little more upside in bonds than you do in CDs. Most bonds pay a steady income, so they're useful if you're looking for a fixed income stream. Bonds can also be used to diversify your investment portfolio and help you hedge your investments against fluctuations in the stock market. If interest rates start to go down, bond yields typically increase, and that could make your bonds more valuable. So if you feel like rates are primed to fall, choosing bonds over CDs might be the smarter choice.
Now, bonds trade on the markets. CDs don't. Now, while investors can choose to hold their bonds until maturity, many can also be sold beforehand on the secondary markets. As a general rule, we gotta keep stating this. Bond prices has an inverse relationship with interest rates. So when interest rates go down, bond prices tend to go up or vice versa. Unlike CDs, you're never locked in with bonds. You can sell at any time should your goals or needs change depending on what prevailing interest rates are. You can even sell it at a premium, realizing a nice little capital gain.
Yeah, and let's talk about the tax advantages of bonds. Bonds are typically tax advantaged. CDs are not. CD income is typically taxed as normal income. So if you have to be in a 24% tax bracket, you'll need to pay $24 in taxes for every $100 of CD interest payments you accrue. However, bonds issued by government often come with tax advantage. For example, Treasury bonds, investors are only required to pay federal taxes. So if you live in a high tax state, that can be very important to you. If you live somewhere like New York, California, Wisconsin, Minnesota, that can be a sizable savings not to have to pay state income taxes. The exemption from local taxes provides significant savings for investors in those high income tax states. Municipal bonds come with greater tax saving benefits. Income from these bonds is completely exempt from federal taxes and may be excluded from state and local taxes as well. So if you buy one from the state, if you buy one from the state you reside in, it'll probably be exempt from state income taxes. So you have to understand what jurisdiction is going to tax your bond. But muni bonds are federally based, you won't pay any federal income tax. And due to that tax advantage, federal and municipal bonds will leave you with more money in your pocket than a CD because you got to pay federal and state taxes on that CD. So the difference will be most pronounced for investors in high tax brackets, right? If you're in the 37% tax bracket and you don't have to pay tax on your bond income, you can accept a little lower return given the fact that you won't have to pay taxes. So you always have to look at your return on an after-tax basis. For example, let's say you have $100 to invest for a year. You get a CD paying 5%. So
Right.
make $5 on CD, but you got to pay 37% in taxes on that CD. Where on a municipal bond, you might be willing to accept a 4% return because you don't have to pay any federal or state income taxes. So make sure you look at the complete picture when you're comparing municipal bonds or bonds that are tax advantaged versus CDs. Take a look at the entire picture.
And that's what a lot of people miss out, though, because you see those returns and you think they're apples and apples, but that tax implication can be totally different. Like you're saying, CDs is earned as income and bonds is capital gains. So that's an important thing. And though, just want to stop and tell people, we're not just preaching to the choir, because me and you both purchased a bond. What was that bond paying? Interest, you remember?
Back then, it was like 9 something. It's
9.65 for 6 months.
Right.
And that was tax, state, local tax free, right, Dope?
Exactly. You don't pay state taxes on that. And then tax rate is 7%. So the marginal tax rate is 7%. So it's a nice little savings.
Right. And once again, it's understanding your portfolio and maximizing your cash. That's the name of the game. It's not how much you make, it's what you do with what you make. And I just wanted to stop and make that point, because it's so important to know that. Now, CDs, they typically have shorter maturity dates than bonds. Like we said, many bonds have long-term maturities of 10 years or more. For example, Treasury bonds mature in 20 to 30 years. CDs usually mature within 5 years, with a few banks offering longer CDs up to 10 years, very few. But for instance, a 30-year-old investor may choose a 70-30, meaning 70% stocks, 30% bonds, as the allocation for their investment portfolio. While this investor could technically continue to buy new CDs every 5 to 10 years to provide a similar cushion against market volatility. That would take a lot more work. And that's an interesting strategy by using bonds and CDs, because bonds usually have longer terms. Okay, Dope.
So let's try to wrap this up. CDs and bonds offer smaller returns, and Bob and I often argue about this because, again, he's much more risk averse than I am. I'm more of a risk taker when it comes to stock investments, and so they offer smaller returns, but they also offer smaller risk, and so both require you to lock up your money for a specific or a specified period of time to receive a maximum return and avoid penalties. Important factors to consider are your risk tolerance, potential returns, and how they compare between CDs and bonds. CDs have almost no risk and have more flexibility compared to bonds with respect to how long you need to put your money out of reach. Bonds carry more risk. That make sure you understand that. The issuer could default, which, I mean, you can buy junk bonds. And bonds are rated. We can, I don't want to go into too much detail on that, but you have rating agencies that rates the value of bonds, and it's everything from AAA down to what's the lowest rated bond, Bob?
Single
Is it
B,
like a
one
yeah?
B.
And so you have that, and within that you got AA, AAA, it goes all the way down. So you can also buy junk bonds, which pay a very high interest rate, but there's a very high likelihood that that company could go over. It's just like anything else. A higher return, higher the risk. And so in some cases you could buy a bond and the issuer could default. Typically won't happen with CDs. Government bonds are considered risk-proof and receive favorable tax treatment. Now we say that realizing that come October, there's going to be another showdown over a possible shutdown and the government not being able to pay their bills. So we have typically always referred to bonds as being, 100% safe,
Right, the safe haven.
but that's up for debate. We'll have to see what happens. So short-term investors should give CDs a close look because again, you might need your money soon. You can buy a CD with a 3-month term. Your money's not tied up long. If you need your money back, you can take it out sooner. You might have to pay a penalty, but you still get all your principal back. Long-term investors may see bonds as the way to go, especially if you're saving for education, you're looking for a tax deduction. Uh, Savings bond denominations as small as $25. And, we talked about being able to avoid some taxes, some federal taxes in some cases, and some state taxes in others. So it depends on your situation, your risk tolerance, how long you're going to have the money tied up, and the overall mix of your portfolio to determine whether you invest in CDs or bonds.
So, on average, most people, and I'm just talking about that I know, do not deal with bonds. Now, they might have dealt with like double E bonds, a savings
Savings
bond.
bond?
Yeah,
Right.
where you buy them in the denomination of $100. They you buy them at $50 and they mature at $100 and stuff like that. But most people I know, and most people, I don't even just say my people I know, though, most people do not venture into bonds. And I think mainly because they don't understand them, for one.
And it is because the number of different types of bonds that are out there are fairly confusing, and typically have to have a broker to buy any other bonds other than savings bonds or tips or bonds from the U.S. Treasury. So you'd have to go to a brokerage and understand what type of bond you're getting. You'd have to actually do some research to determine how strong the entity is, whether it's a municipality or a company. You'd have to do some research. And so I think that's why a lot of people don't really invest in bonds. But it should be part of your portfolio. And we always talk about diversifying. And if you are diversified enough, when something bad is happening in one part of your portfolio, something good should be happening in another part if you are fully diversified. And that's the joy of having money in each of the different vehicles we
Asset
talk
classes. Asset
about.
classes.
You kind of spread your risk around, and you usually one of the three is usually going the right way.
And so, dope. So when you say, a diversified portfolio, like say when certain investments are up and others are down, or certain investments go down and others go up, I have a question about what do you mean inverse relationship? And what that means is normally when interest rates go up, bond prices go down. And the theory is if new bonds come out and they're given higher interest rates, then if you had bonds that had lower rates, they're not going to be as attractive. People are going to go to the new bonds with higher rates. So you lower the price on the bond if you want to sell your bond that had a lower rate. But if
Well,
go ahead.
let me try to explain it. And it's an accounting issue, but an easy way to look at it is if let's say buys a bond, it's paying 4%, but then interest rate go to 5%. and he wants to sell his bond. He has to, and now bonds are paying 5%. Bob's bond, I'll say Kinzer's bond is paying 4%. He has to lower his price such that his bond is now paying 5%. Okay? Because nobody would ever buy his bond at 4%. The only way you'd buy it is if you invested enough, and when his interest payment came due, that it paid me 5%. So he's got to lower his price in order for me to get the 5% that I could get from buying any other bond. So that's when you talk about selling at a discount. So he has to, so his return is equal to the return that's in the market now. So his price is now maybe $950. And so when he pays that periodic interest payment, it equates to a 5% return, even though the bond is only paying 4%. So he lowers the price to increase the interest rate, which allows him to be competitive with the 5% interest rates that are currently in the market. Does that make sense?
Yes. So the inverted relationship, when bond prices go, when interest go up, bond prices go down. We get it right, and then vice versa. So another strategy. Go ahead.
Go ahead. No, I'm saying if interest rates are going down, okay, and so you got to raise the price on the bond to make that interest rate lower. So that's when you get a premium for selling your bond. Please.
And I'm telling you, and if you have some questions and you don't understand, put it in the comment box, because this is important to know. Now, another strategy, though, of dealing with interest rates, period. Like, let's talk about the Fed raising interest rates, right? But with that, now this relationship happens. Savings accounts and CDs and money markets start raising the rates. Like I told you, remember, savings accounts with less than 1%. Now you can get 3% on some savings accounts, though you can get 5% now, 4 to 5%. So that's another interest, dealing with interest rates, keeping an eye on interest rates and developing your portfolio that can handle, any kind of situation. When things go up, you have ones that deal with that goes up, investments. And when it go down, the other side, you have ones that take advantage. And that's what we mean about a diversified portfolio, having some, some safe investment returns like CDs, money markets, and bonds. And then we talked about taking some more risk, high risk. Remember, we always talk about the term, no risk it, no biscuit. And the more risk you take, we know this theory, right? The more the return you get. So, reason why we wanted to share this, because I know and we both are pro stock market. It's just that Dope is more aggressive in the stock market than me. I'm in the stock market too, don't get me wrong. But Dope is a little bit more aggressive than I am. But it doesn't mean that, he's more right than me. What it does mean, he just makes more money than me. No.
Level of risk that you don't want to deal with.
Right.
That's okay. You probably sleep better at night than I do,
Yeah, but when I look at the video that you have, and it's done triple your earnings, that makes me not sleep well at night. The other way. That's the
way kids' college paid for,
Yeah, no lie. But these are some things we just hope that you understand. And look, you all, if there's some things, and I know we'll be rolling with a lot of terminologies, and there's nobody stupid on this line, okay? There's no stupid questions. So, put in the comment box, to slow us down if you have a question or something that you didn't understand that we say. Feel free. And for those individuals who are afraid that I might put your particular comment up on the screen, I won't put your comment on the screen. So you have, what is it called though? Anonymity? Is that the right word? Yeah, spell it right. But so I won't put your name up there if you feel that you might seem stupid. But remember, with us, the only stupid question is the one you don't ask. And
Yeah. I mean, this is something, Bob and I talked about this before we decided to do this topic, and we thought most people don't buy bonds and don't, other than government issued bonds. And you should probably look at something else. Look at company bonds, which are paying a good interest rate, or municipal bonds, or from your municipality, from your state, or from your county, or whoever that might be paying a very good interest rate, and it gives you the opportunity to diversify, make a decent interest rate, have some tax advantage products, and spread your risk among different investment vehicles. And that's something that we typically don't do. You don't, and like, I'll push stocks. No way I would ever be 100% in stocks. That's just, again, I'm not that risky. There are some people who are.
so even Dote has a risk tolerance.
Somebody who's 100% S&P index. Whatever the S&P makes, that's what he makes. He's got 100% in there. I would never do that. But it's no right or wrong, as Bob said. It's all what you're comfortable with, what your goals are, what you're trying to accomplish, and what your time horizon is for your money. That really determines what money is. But the points we want to make is consider other investments other than just CDs, diversify your money, but most importantly, make the most out of any idle cash that you have. Don't leave money sitting in a savings account, especially a bank saving account that's still probably only paying 1% or less than 1%, when you could have it in a money market account or an online bank account. There's so many high yield interest rate or savings accounts now between Robinhood and Fidelity, Schwab, E-Trade.
Yeah, but I like to stay with FDIC insured.
Yeah, but a lot of some of them are okay. I think Robinhood is. I think
No,
Robinhood is.
they're not a bank. Their money's not in the bank.
They work through a bank, and it is FDIC insured. Check it out. It is.
Oh, that's pretty cool to know. But
Yeah,
no, I want
I think Amex, also American Express, also works through a bank and provides.
they definitely are FDIC insured. I know that for a fact.
Again, if you can up your savings from 1% to 4.5%, 5%, that's going to add more money. It's going to add more wealth, more value to your portfolio. It only makes to do that. It's just a matter of taking the time to do that. They always talk about how difficult it is to change banks, to change phone carriers, and banks, phone carriers, and spouses. Those are the three things that are hard to change, and they are difficult to change. But in two of the cases, if you need to do it, you need to go ahead and do it, because you got to find a way to maximize.
I want to share before we go into the summary takeaways another formula and it's good to use ratios, you all, and different formulas. For instance, like how we talk about 70-30 investment, or 60-40, 70%, bonds, 70% stocks, or 30% bonds, 60% bonds, 40% stocks. There's another formula I want people to think about, because it's about the time value of money, or more so the purchasing power of your dollar. Why you can't just sit on it and put it under your pillow in your mattress. For instance, example, talked about the the CD that was taxed, right? And if you're in a 24% tax bracket and you're making 6%. No, let's say right now 5%, right? So that's about what, though? Probably getting about 3% after taxes,
Yep.
right? And then the other factor you need to factor in is inflation. So as inflation is right now around about 2, now you take 2% off that, and that 5% that you thought that was a great little rate, Now you're only making 1%, and that's called the purchase power of your dollar. That's why you can't just sit on it, you all, because I give this situation all the time. If Clorox last year was $2, and you just had $2 sitting under your pillow, and next year Clorox is $2.50, and your money didn't go, guess what? You will not be able to purchase any Clorox. So please understand the tax implication and the effects of inflation, and that's the purchasing power of your dollar. And that's why we say you don't want to end up short with more month at the end of the money when you get to around about 68, 69, and you're thinking that your money that you had in a savings account, that was earning 1%, and you wonder why you can't get ahead because inflation. Remember last year, inflation went up to 9%, though, and it was eating through people's savings like wildfires. So don't forget that. Just want to share that. So let's go to the summary and the takeaways, because we really, as always, had a lot of information, and we just want to go over it before we get out of here tonight. So, is it on me though? Yes. So, understand your risk tolerance. We gonna beat that horse. We're gonna roll that horse down the valley and back up the other side. But you know why? Because it's so important, you all. Your risk tolerance determines what investments that you can be in so that you can feel more comfortable, so you don't feel stressed. So understand your risk tolerance, which is different than the next subject that Stokes want to talk about. The risk tolerance is how much risk are you willing to take? In other words, like we always say, what risk level are you willing to take where you can sleep at night?
And remember, lower risk, lower return. And don't take that as a negative. If you're comfortable with that, just understand what that gets you. But it's also peace of mind of not having to worry or not having to lose a substantial portion of your principal if you are taking lower risk. But just understand, lower risk, lower return, higher risk, higher return. Okay? Make sure you understand that.
And bonds have a place in your portfolio. I don't care who you are, if you are earning an income, even if you're in retirement and you're still earning retirement income, bonds have a place in your portfolio because how the risk works, cash equivalents like CDs, savings accounts, and money markets, they are the lower risk. The next up is considered moderate risk, and those are usually bonds. And the next up is usually stocks and other and high yield, high risk investments. So bonds do have a place in your portfolio.
If anything we want to leave you with is this, make the most of your cash. There's so many different things that are draining your money from inflation and everything's going up to taxes increasing, tip inflation. I mean, there's so many things for money. You got to make the most of your cash. You got to optimize what you're making with your money. And a lot of times it's easy to do if you do a little research and seek out the higher interest rate products. Be very careful. Make sure you understand all the ramifications of that account. Read the detail, read the fine print so you don't get surprised. Make sure you understand what the fees are. It's like, for example, Robinhood has one account, and I'm estimating the returns, but I think one account's 4%, and they have another account that pays, I think it's like 4.75%, but it comes with a 10% monthly fee. And so obviously, that dollar amount, it makes more sense to have in the 4.75 account and paying the $10 a month fee. But those are the kind of things you got to take the time to do. And we keep trying to remind you that making money ain't easy. It requires work, it requires reading, it requires research. But in the long haul, if you do those things, you'll probably end up better off.
And I know people who spend months shopping for the car they want to get the right price that they want. And they take, I mean, I know a guy took 6 months and he got the car that he wanted. But when it came to managing his other finances, though, he didn't take no time. But he wanted that car and he put the time in to get the car he wanted. And he got it for the price that he wanted, which is a good price. But when I looked at his other investments, he didn't spend the same time. So that's all we just want y'all to get the information, because that's what the FITT Show is all about, providing you with the knowledge. Now, what you do with it is up to you, but you can't say, we didn't tell you. And that's all we want to do, is just provide you with the tools to be able to go out there and maximize your cash. So with that, we want to thank everybody for tuning in again. My wonderful sisters. I don't know what happened to Nolia. I see Linda and Gloria out there, but I don't see Nolia. She must be busy. And then I want to say to Rodney L. Madison Sr., the NoteExperience.com. What's up, Rodney? And my good brother, Carl Chapman. My deepest condolences to your sister-in-law, Audrey Ford, the past of a day. We love her so much, and may God be with her. May she rest in paradise, Carl. Maddie Ford, a stalwart. Thank you for always hanging in there with us, Maddie. I miss you too, girl. So look, you all, thank you once again for tuning in. We'll be here next week, same bat channel, and look forward to, what is next week? The 31st, though.
Yep, last day of August.
Man, Doe, the time is moving by so fast. But a guy told me this the other day. The days are long, but the years are short. Make sure you maximize them, y'all. Have a great evening, and thanks, Doe, for another great show.
You too, my brother.
Peace.